Okay, can you hear me?
Yes.
Hello?
Yeah, you're good, Al. Start us up.
Okay, good. I'll just turn mine up a little bit. How's that?
That's perfect.
Okay, apologies. I got looking and I had the invite for the meeting, but not the Zoom invite. Anyways. A quick call the meeting to order. I acknowledge that we are live, work, and play on the traditional territory of the Secwepemc people, and the meeting is being held across the Secwepemc territory. And I must apologize. I'm not feeling very well, so I may be hacking the odd time. I'll try and mute myself. We've got the minutes from the February 3rd meeting in draft form. Recommendation that minutes of the audit committee dated February 3rd be adopted as circulated.
So moved.
Second. Call the seconders. I hear. Yep. Call the question. Anyone opposed? Hearing none, motion's carried. And we're on to the financial statements, and Mr. Ashby's there going to join us. The floor is yours.
Thank you, Director Rain, and hope you feel better soon. We're going to start with going through the Tnrds financial statements for the 2021 fiscal year. Like maybe we'll wait for that to come up on the screen here. There we go. All right, so we'll go through the Tnrds financial statements, followed by the hospital district financial statements, and then our audit findings report in that order. So, and I've encouraged Doug too to provide any comments as well as we go through the financial statements. So first of all, as you move into the financial statements, there's past the table of contents, there is a management's responsibility for consolidated financial statements, and that is basically required under public sector accounting that basically lays out what management's responsibility is for the financial statements, and also discusses that the board has hired KPMG as the independent auditors to audit the financial statements and express our opinion on the financial statements. So that is the next page past the management's responsibility is the independent auditors report. And to summarize the financial statement, or summarize, sorry, our audit opinion on the financial statement is right at the top of the auditor's report, that we have audited your financial statements for the 2021 fiscal year, and that we provide an opinion that the financial statements are presented fairly in accordance with Canadian public sector accounting standards. From there it goes into our basis for opinion and the responsibilities of both management and the auditors over the next couple of pages, and that we expect to have the statements approved at the board meeting on May the 5th. After that, we get into the consolidated statement of financial position. And I guess if you look overall and compare the end of December 2021 with 2020, probably obviously the biggest impact on the financial statements as a whole would be the fire and flood activity in 2021. So, but to talk about, the overall financial assets, you could see that your total financial assets are up from 51.2 million to about 57 million in total at the end of 2021. 49 million is in cash and cash equivalents, which would include about 11.5 million in money market funds in that cash and cash equivalents line. Accounts receivable is up significantly with respect to about 4.8 million outstanding from the province for emergency operations at the end of the year, offset by a decline in some grants receivable that were there in the prior year for the water meter project. On the liability side, consistent with the increase in accounts receivable is an increase in accounts payable with respect to the flood activity in the November-December period prior to year end. So additional supplier charges and invoices outstanding at December 31st. So that's gone from about 3.3 to about 6.3 million. Deferred revenue has also gone up about almost 2.2 million over last year. And the bulk of that is in two lines. And we'll look at the notes in a minute, but 1.3 million that's still deferred related to a grant for the Pritchard water system. And about $1 million increase in your community works grants that are deferred at 2021. In terms of debt, there was no new loans taken out in 2021. So there's been a slight decline in both the facilities loan line and also long-term debt has gone down to just under 1.9 million. Landfill remediation liability, which is your present value of your future costs to remediate your landfills, both the ones that are currently operating and the ones that have closed in prior years, is gone up from about 7.8 million to just over 8 million at the end of 2021. So your total liabilities have increased somewhat consistently with the increase in total financial assets, and they've gone up from 20.4 to 25.6 million. And your net financial assets have edged up about just over $600,000 to just about 31.4 million. Tangible capital assets, so that would be equipment, infrastructure, buildings that are owned by the TNRD. They include about 5.6 million that you spent on capital additions this year, including the Eco Depot for Cache Creek, water meters, library books additions, some other equipment during the year. As I said, totaling about 5.6 million. And then the other change in the balance would be the current year amortization on your tangible capital assets. No real change in prepaid expenses. They're around 200,000. So total non-financial assets added to the net financial assets means your accumulated surplus at the end of the year is about 87.4 million, up from 85.1 million last year. Included in that accumulated surplus is about 19.5 million for operating reserves and another 5.6 million for capital reserves. Moving to the statement of operations. You can see that overall total revenue is increased from 35.5 million up to 40.4 million. No real change, actually a slight decline in tax requisition by about 400,000 to 23.2 million. The big increase is in government transfers and other grants, as you might imagine, about 5.3 million for emergency management during the year. So that was the bulk of those government transfers. User charges, you can see sale of services have gone up just over 800,000 to about 4.6 million. And obviously a strong year for building. So building permit revenues have gone up. Tipping, recycling fees, also some increase in those categories as well. Interest is gone down during the year, not surprisingly low interest rates that we've seen over the last while. Those are obviously starting to change in 2022 with some increases. Other revenue has gone up. It's gone up to just over 1.4 million, and that would include some amounts that were received for contributions for the Pritchard water system, was in that line. There is a loss you can see on disposal of tangible capital asset, and that really relates to the leasehold improvements in the Lytton Library that was destroyed by wildfire in July. And that maybe or is expected to be recovered in the current year with insurance proceeds, but at the time of the financial statement had not yet been satisfied. Expenses, they have also gone up, mainly in the area of protective services, which consistent with the grants received from emergency management during the year. You can see that they've gone up. I think there was an additional 4.5 million of costs related to fire and floods in 2021. Some increase also in general government, about $500,000. That would include professional fees regarding the forensic matter during 2021. Environmental health has actually gone down during the year. That's still by in quantum, the largest of the expenses within the various functions and segments. But that's really the change there is more or less in 2020, there was a much larger accrual related to the landfill liability than there was in 2021. So 2020 had about a $2 million addition, and this year was down in the couple $100,000 range. Waterworks and sewer, very, very consistent. Recreation and culture, there's some increase there as during 2020, there would have been some closure of the libraries, and so staffing levels and things like that were down. So the costs have kind of gone back to pre-pandemic levels there in terms of recreation and culture. So overall, your annual surplus is relatively stable with 2020, $2,287,000. Last year, $2,410,000. I won't spend a lot of time here. On the next page is the statement of change in net financial assets, but you can see this is a reconciliation back to the statement of financial position on your net financial assets line. It's gone up by overall $630,000. How you get there is reconciled here, but I guess the biggest thing to point out would be the acquisition of tangible capital assets, which were about 5.6 million last year, as compared with about 4.2 million the year before. Cash flow statement is on the next page, and you can see that, sort of summarizing your change in cash. And as I said when I went through the statement of financial position, your total cash and cash equivalents are 49 million at the end of 2021, as compared with opening the year at 47.7. So overall, your cash went up by about 1.3 million. Operating activities generated just shy of $7 million. You purchased capital assets of about 5.6 million, and then you paid about $100,000 back on your long-term debt and facilities loan. So that's really your sort of overall change in your cash position for the year. And down below, just some additional information. Cash paid for interest during the year was about 67,000, and the cash received for interest was 318,000. Going into the notes then next, in terms of this was a year with not a lot of significant accounting policy changes. So note 1 would have been relatively similar to what was reflected in the prior year's financial statements. There are some comments in here as well about, we've talked about it at the audit committee level before, is there is some future accounting changes coming, specifically the asset retirement obligation, which will change how you account for your landfill liabilities in the future, but that is coming in the 2023 fiscal year. So we're still a couple years away, and that's noted in 2A of your financial statements. And really at this point, we haven't reflected or actually determined exactly what that impact is going to be on your financial statements at this point, but it's something that we worked on, and I know that management's paying close attention to what assets will fall into that category of requiring some sort of liability in the future when those assets are retired. We flip to note 3. Again, this is just a breakdown of your cash and cash equivalents. Again, as I mentioned, some of it is in money market funds, which are generating last year only 0.15% return, as compared with 0.87% in 2020. Accounts receivable, again, as I mentioned, going through the statement of financial position, you can see that a large portion of your accounts receivable is from the province for emergency program and emergency operations center grants. And the other larger amount there is just other regular trade and accounts receivable. Deferred revenue, there's a number of components that make up your deferred revenue at the end of 2021, the largest of which is the Canada Community Building Fund Community Works Grant, which is 7.2 of the 9.4 million in deferred revenue. And as I mentioned, new this year added to deferred revenue is the province BC, the Pritchard Water System Grant that you received almost 1.6 million, but at the end of the year had recognized about 274,000 of those revenues. Is that project still in progress? And Trans Mountain, you can see recognize some of their community benefits grant of about 205,000 in the current year. And that amount was included in other revenue. Facilities loan, this was taken out in the prior year, relates to the Lytton Library. You're continuing to make payments on these loans. Obviously, as we discussed, the library was destroyed by wildfire, and we expect to receive some insurance program proceeds in the near future. Long-term debt is made up of various debt instruments through MFA. And on note 7 details the various MFA issue number and the bylaw numbers of the TNRD. As I said earlier, there was no new loans taken out in 2021, and you opened the year with a balance of 1,989,000. You paid about 88,000 in principal, and then there was an actuarial adjustment of just about $16,000. And the next 5-year payments are noted there below. Also noted, the weighted average interest rate for all your debt is about 2.73%. Landfill remediation is described in note 8. And as I said, the liability's gone up slightly, just under about $166,000 increase during the year. There's lots of, and I think I've said this many times in the past, there's lots of assumptions and interest rates and, future inflation rates that go into this calculation. I know at this point it says, they're using any inflation rate of 2%, and some may say, well, why would you use 2%? We've got a current inflation that's running much higher than that. And I think that would be an obvious question, but you have to remember that these are very, very long-term liabilities, and the liability is going to be satisfied over 100+ years. And generally speaking, the government's always sort of targeted a 2% long-term inflation rate. So that's why, we've looked at management's assumptions, and we concur with those assumptions using a 2% inflation rate and a 2.2% discount rate. And those, like if you look at the projected closure date, just to give you an example, is that Heffley Creek would be 2111 and Lower Nicola would be 2094. So both of those well into the future. So those costs are spread out over a significant amount of time, and that's just the closure. And then you've got many, many years of post-closure care on those landfills. Note 9 is a reconciliation of your tangible capital assets and breaking down by categories where you spent the 5.6 million in tangible capital asset additions during the year. A bulk of them are under construction at the end of the year that haven't been amortized yet. So that would be about 3.2 million of the assets that you purchased during the year. And then you could see that there was a fair amount of additions in vehicle, machinery, and equipment. And there's a note there also at the bottom that where the leased assets and improvements was written off for the destruction of the Lytton Library. And as that ties in with the loss that was recognized in the statement of operations. The next page is just the same comparative for the 2020 fiscal year, showing the reconciliation of additions and disposals on both the cost and the accumulated amortization side. Note 10 is your accumulated surplus and how this ties back to your statement of financial position. So, you know, at the top, you can see that unrestricted surplus is about 62.4 million. Operating reserves are about 19.5 million, and capital reserves are about 5.6 million, making up the 87.4 million of accumulated surplus. Now, really, if you break that down in terms of unrestricted surplus, the largest amount is in tangible capital assets that are already existing assets of the TNRD of about 53.4 million. And other unrestricted would be about $8 million. Operating reserves, you can see there that during the year, you added certain amounts in interest income and contributions to operating reserves for about 1.1 million, and you transferred out about 410,000 out of operating reserves. So the largest of the operating reserves relates to solid waste management, which is about 11 million of the overall 19.5 million reserves. Capital reserves is on the next page, on page 23. And you can see that in total about 4.4 million, or sorry, that's just a subtotal, apologize. It gets to about 5.6 million in total, the capital reserves. And during the year, you added about 512,000 to the capital reserves, and you transferred out 289,000. So again, these belong to the various functions within the TNRD. Note 11 goes through commitments and contingencies. A being legal, describing that, you know, you might have from time to time face lawsuits or claims, and generally speaking, there isn't any the exposure as such is not determinable or not considered to be significant for any matters that may be currently underway. You're also a member of the MIA Association of BC, and that you're maybe contingently liable for claims in excess of the insurance fund that you're a member of. Pension liabilities and 11C, you're part of the municipal pension plan, and as a member, a multi-member organization, this just describes the indicated valuation for funding purposes, that there was a 2,866 million, so 2.8 billion funding surplus for basic benefits the last time there was a valuation. And as a multi-employer plan, you just expense your contributions to the plan as they are made and recognize the expense as you go. So in the current year, you contribute about 775,000 of employer contributions. And we expect a new valuation in the next fiscal year. 11D just goes through some commitments related to the landfill and transfer stations and eco depot and what those expected costs would be over the next number of years. And 11D, debt reserve funds. So you've got some cash deposits and contingent demand notes, both for the TNRD and member municipalities held with MFA. And that's described in note 11E. And you are contingently liable for liabilities to MFA for other member municipalities. So that is described in note 11F, and that the total MFA debt amongst the other member municipalities is about 94.6 million. And that's down from 102.1 last year. And finally, 11G just goes through contracted services. So you might have leases and other commitments for land and buildings or vehicles, service agreements over the next number of years. And that's described in note 11G with a total over 5 years of 17.3 million. Note 12 describes a little more detail on your government transfers during 2021 and 2020. 5.3 million, as I said earlier, was from the province for emergency management program. Community Works Fund was about almost 1.2 million. So those are the two largest of the government transfers and grants in 2021. And that's up overall from 5.5 million last year to 9.8 million this year. You also received some additional funds under the COVID Restart Grant Program in 2021. And there's a schedule at the back of the financial statements that's required to show how you're spending those funds. Related party transactions, the only related party transaction is with the hospital district, where there's a fee for service between TNRD and TRHD. Note 14 goes through the segmented information, divided your various segments that tie back to the statement of operations, but you can see that on the next page is the start of those segments. You can see that in total, where your surplus and deficit by function is. Obviously, it's a bit subjective because tax requisition is something that isn't specifically taxed by function, but it's allocated based on a methodology consistent with prior years in terms of maybe where you budgeted for costs in those areas. You could see that, general government with a small deficit, as same with transportation services. And carrying on the next page is the remainder of the segments. Yeah, thank you. And again, recreation culture with a small deficit as well, and then waterworks and sewerage with surplus. There was some capital grants you can see under waterworks, which creates the larger surplus in 2021. Same for 2020, and I won't go through in great detail. This would have been in the prior year financial statements. This in note 15 just requires a reconciliation from your statement of operations back to your financial plan that you originally completed when you did your original budget at the start of the year. And your financial plan is much more of a cash basis where you recognize things like debt proceeds and show a cash payment for tangible capital assets. Well, in your financial statements, the statement of operation reflects public sector accounting standards where you don't expense tangible capital assets as you spend money on it. You record amortization over the life of the asset. So this provides a reconciliation from the surplus budgeted of almost 4.4 million back to your neutral financial plan balance. There is still a COVID-19 note. Hopefully we're not going to see this another year, but here we are, basically saying there's still some ongoing uncertainty around COVID-19, that you've had pauses in services at times, more likely over in 2020 and 2021. You certainly didn't have the same level of impact on operations. But there's still some uncertainty that there could be future impacts. We don't know at this point. And note 17 just describes the fact that certain comparative figures may have been reclassified within the accounts. Doesn't have an impact on overall surplus for the year, but it's done to conform with consistency with the current year presentation. And the very last schedule, which you would have seen last year as well, is the COVID-19 Restart Grant. This is an unaudited schedule, provided by management. The province doesn't require any specific auditing to be done over this schedule. But you can see you had 947,000 received in 2020 and carried forward to this year. You received another 429,000 in 2021, and then you spent about 162,000 in the current year. So you still have about 1.2 million that you've allocated to be utilized in 2022. I will pause there. See if there's any questions on the financial statements before we move forward. Yes, sir.
Thank you, Brent. Perhaps staff could answer this question first. The North Kamloops Library was a strata corporation. Is that fully discharged, or how does that work? And I don't see an actual reference in here to the North Kamloops Library if there's any debt involved.
The strata corporation that's consolidating the financial statements is this building. It's the strata that holds this bid.
So the North Kamloops one is done.
I don't, maybe ask management to, it was never an entity that was consolidated into your financial statement.
That's why it's not there. Do we have a status on it at all?
No, nothing has really changed. I don't think we have it set up as part of a strata corporation. We kind of have a ownership share, and we've just capitalized that ownership share, and we pay common area costs, but we're not really setting up it as a strata corporation. We're in a management position of, unlike this building where we are between the city and the Tnrd. We have the strata corporation that we manage here. For the North Kamloops one, it's really just costs we incur that we record
Within the library budget?
Yeah.
Okay, thank you. I just didn't see it here. Thank you.
Thanks. I had a similar question, but it is about this building. So is there not a separate set of books for the strata corporation that manages this organization here for the building?
There is. All the operations and the assets and the liabilities are all included though on a consolidated basis.
So this just
75% portion that's owned by the TNRD.
okay. So the TNRD's share of the obligations for this strata corporation's reflected in this, and you would file with the Societies Act, I guess, the strata budget for the building itself.
Yeah, and a corporate tax return is done for the strata itself.
Okay, the reason I ask is we're the other shareholder in this, and there's rumors about a roof problem, so. My second question, and I think I have the answer, but I'm going to ask it anyway, is this cost of the BDO forensic audit, which occurred last year. And as I'm reading here in the overage for general government services on page 32. And then we had an over expenditure there of about 200,000 or 250,000. So does that reflect the fact that we saved some money in general government services and then paid the $500,000?
Well, you budgeted more than what was spent in general government, yes.
Okay.
But I think my comment, if that's what you're referring to, was comparing 2021 actual with 2020, which has gone up by about 500,000 or 600,000 in total.
Which would be the reflection of that anticipated cost. All right, great.
Yes.
Now, does it break down legal costs as well as accounting costs in that category?
It does, but not in this statement, not to that depth.
Okay,
But yeah, in our, and I can certainly provide that information at that amount, but my recollection was, and Scott might remember, that our legal costs in general administration last year were somewhere just north of $100,000.
yeah, that's pretty reasonable compared to mine. My final question, and you referenced it early on, was the Environmental services costs and a differential in there of about $2 million related to a one-time cost in 2020. Is that for the landfill continuous operations? Is there a surcharge in there in 2020 that wasn't there in 21?
2020 there was a larger accrual for the landfill liability that's recorded. So a non-cash item. So there was about a $2 million expense in 2020 related to an increase in the landfill liability.
So my question then is, why was that accrued then, and why is there not a continuation of that obligation?
I'd have to go back to the actual report, but it could have been a change in the discount rate at that time. So some of those assumptions and factors that go into the liability, it can have, significant swings when you change an interest rate or or an inflation rate. I'd have to go back to the exact things, but in the current year, they were relatively stable. The same discount rate was used, and the same inflation rate was used in calculating those future costs. And I can't recall if you had a new report that was received in terms of those estimated future costs from the engineers in 2020 or not. Maybe Doug can provide some, he recalls that exactly.
Yeah, you're absolutely right, Brent. The discount rate in 2020 decreased from what was used in 2019. And we look at it every single year. There is some guidance in the accounting standards on what rate we should use, but it's fairly vague. Generally, we've been looking at the long-term borrowing rate with MFA. And in 2020, that had dropped significantly, partly due to COVID. And so when we decrease the discount rate that we're using, it has an impact of increasing the liability. And I believe as well, if I recall correctly, we did have an updated report from the landfill engineers that we use. We get updated reports from them periodically to give us an estimate based on the amount of fill and airspace being used in the landfills, how many more years they're going to last before they get filled up. And so every year when they look at it, if the fill is slightly more than it was previously estimated to be, that can have, over 100 years, it has a cumulative impact. And so if we're swinging the closure date of the landfill by 10 or 20 years, one year to the next, that has an impact on all those calculations too. So overall, it was a larger jump than usual from 2019 to 2020 of about 2 million. That hasn't generally been the case in the past. And this year, it was a more stable, as Brent alluded to. It wasn't as much of a change.
Okay, the reason I asked, there's two things that drive that liability cost. One is methane capture, and the other is leachate collection and treatment. But I didn't recall us having any expenditures in those areas. So what you're telling me is that you have an amount moving forward for that in all of our landfills, plus you're actually covering the cost of a new landfill when this one gets filled, and that's the future cost in there?
Well, not quite. What we're required to reflect as a liability are the costs to close the currently operating landfills. So we basically look at if the engineers tell us they're going to close 100 years from now, and I get an estimate of what it's going to cost in today's dollars to close it, and then I have to factor in inflation and figure out 100 years from now, what's the likely impact going to be on cash, and then apply a discount rate to figure out what we should be reflecting it as a liability. So there's the closure cost to cap off the landfill, seal it off, do any remediation necessary if we need to plant more trees or whatever. And then there's 100 years of post-closure monitoring costs that we also have to accrue in that liability. So we're looking at a 200-year spread of what we think those costs are going to be, what the impacts of inflation are going to be, and what we could invest today with returns on investment to have a right amount of money in the bank 100 years from now. And generally, the funding for it comes over the life of the landfill as we charge tipping fees and taxes, we're putting a certain amount aside to match up with what that liability is, so that you're kind of matching the revenue stream from the waste going into the landfill with the accrual of those future costs.
And that operating reserve that was pointed out, that's exactly what I think Doug is referring to, that those, as you're collecting those tipping fees, that reserve is increasing, then that's there to help fund those future costs.
Thanks, Al. I'm good.
Okay, any other questions, comments? Do we need a motion to recommend that the financial statements get referred to the board? Okay, call the question. Anyone opposed? Hearing none, that motion's carried. And we're on to new business. And I did have, I don't know if any of you have comments under new business. I have one.
Sorry, can I just jump in? I think we still have the hospital district statements
Oh,
to
yeah.
walk through and the audit findings report.
Yep, sorry, forgot about that. Let's go to the hospital.
So we'll take you through the hospital district statements. We'll maybe flip right to the independent auditors report. Thank you. So again, we provided an unqualified opinion on the 2021 financial statements of the hospital district, and that the financial statements are fairly presented in accordance with Canadian public sector accounting standards. Once we get past the auditor's report into the statement of financial position, it's on page 5. So you can see there that you continue to, you'll see in the statements of operations, you continue to fund major projects like the patient care tower from the hospital district. At the end of 2021, you've got cash and cash equivalents of about 62.2 million. 18.7 million of that is in money market funds. The term deposit that was there at the end of 2020 has been cashed in and moved into the bank account. Total financial assets have declined from 93.6 to 63.6. As you'll see, you'll incur a current year deficit with the result of paying for costs like the patient care tower in 2021. On the liability side, accounts payable is down slightly from last year to 1.8 million, and long-term debt, the borrowing related to the patient care tower has gone down from just under 119 million to just under 114 million. And your net financial assets and accumulated deficit has increased to just shy of 52 million. On the statement of operations, the next page, you can see that tax requisition has gone up by just over 200,000 from last year to 15.9 million. Interest has gone down as a result of fewer funds in the term deposit and the money market funds as compared with the prior year, and decline in interest rates. So about $1 million of interest generated. Actuarial adjustment to debt was 335,000, and grants in lieu of taxes was consistent with last year, about 91,000. So total revenue is just over 17.3 million. Expenses have gone down during the year. In total, we're 41.6 million as compared with 62.6 million last year. The interest is consistent with last year on your debentures, but the grants to IHA have gone down from 58.4 to 37.4 during the year. The annual deficit has also declined from 44.2 to 24.1 million. We go right to the statement of cash flows. Next page. You can see that operating activities are generated a negative cash flow, and all this was anticipated, obviously, as you are funding major projects with IHA. Generated negative cash flow of 25.1. You had positive cash flow of 21.5 from cashing in your term deposit during the year, and then you repaid debt of almost 4.8 million during the year. So overall, your cash and cash equivalents declined by 8.4 million. And at the bottom, you can see your cash paid for interest was just over 4.1 million, and received from interest was just over $1 million. The notes, the statement, similar to TNRD, there's no major accounting policy changes during the year. So maybe we'll move right to note 2. Again, as I said, looking at the statement of financial position, here's your cash and short-term investments that are comprise the cash and cash equivalents balance, and that MFA pooled money market funds generated 0.15% return during the year. Your borrowings are still the same borrowing that you had at the end of 2020. MFA issue number 146, and you repaid almost 4.8 million in principal and had a actuarial adjustment of about 335,000, and that your loan interest rate is 3.2%. Next 5 years repayments are noted on the top of the next page, that you'll repay, you're still repaying about 4.8 million of principal for the next 5 years, and then there will be thereafter another 57.5 still outstanding, less any actual adjustments. Debt reserve funds in terms of cash deposits and contingent demand notes are noted in note 4A, includes cash deposits of just about 1.4 million. And you've got commitments noted in the top of page 13, note 4B. Outstanding commitments to IHA are about 49.2 million. And it also goes on to describe the board commitment for the patient care tower that was there in 2016 of 172 million. Note 5 just describes a similar related party transaction as you saw in the TNRD financial statements for $11,000 for services provided by TNRD to the regional hospital district. Note 6 just describes the surplus as compared with last year. You've got certain reserves that are there. So unappropriate surplus at the end of the year is 96.2 million. You've got a section 20.4 reserve of about $1 million, and then reserve for capital, future capital of 43.2 million. And then budget data reconciliation is in note 7. The deficit described in the statement of operation budget of 42.1, and you can see that you expected to transfer monies from reserves and pay off borrowings and transfer from operating reserves in order to bring your financial plan balance back to balanced at nil at the end of the year. Those are a little shorter and simpler financial statements, but I'm happy to take any questions on those before we move to the audit findings.
Any questions? Seeing none,
I move they be adopted, Al.
yeah, and forwarded to the regular board meeting, presented at the regular board meeting. Okay.
Okay, one more
Seconder.
document then to go through is the audit findings report.
Yeah, okay, yeah, so that motion's carried. Audit finding report.
So this is a document for the audit committee, provides additional details about our audit, also includes some past financial results, and then in the first section, and then goes into any audit findings that were required under our audit requirements to bring forward, or other matters that we identified during the course of our financial statement audit. So if you flip to section 1, this is just, I know it's a little bit busy and it's got a lot of information, but I think what it does is just points out the last 5 years in terms of revenue and expenses of the TNRD. And I think as we were chatting just before the meeting, you can see that relatively speaking, your most categories are fairly consistent in terms of revenues and expenses over the 5 years. Where you see the bigger increases on an annual basis is certainly when we have significant events like 2021 with fire and floods, where you've got significant cost in protective services, similar to 2017, which was another significant fire season. And then on the government transfers and grants side, you've got the same sort of jump in government transfers as you received funds for emergency management. So tax requisition wise, and is actually gone down from where it was back in 17 and 18 in terms of gross dollars, and is relatively consistent over the period. Same with other categories like water and sewer. There's relatively consistent over the 5-year period since 2017. So again, it's something just as a point out of 5-year. Some of the, I won't go a lot into all details over the next number of grants as you get, or sorry, graphs is over the next number of pages, but just on the next page, just goes through, shows a little snapshot of your statement of financial position and your financial assets, specifically intangible capital assets. You've seen some growth in the tangible capital asset line over the last number of years, which, as I pointed out, you spent about over $5 million this year in tangible capital assets, over $4 million in 2020. In previous years, you took over a number of the fire departments and fire halls within the regional district. So that's added to that tangible capital asset line as well. And something like accounts receivable obviously can vary depending on what's outstanding at a point in time at the end of the year. The next thing on the liability side, you can see that that's on the next graph in green is the liabilities. It's gone up and jumped in 2020 and 2021. Again, that's a lot driven by what's outstanding in accounts payable or what new debt has been brought on along the way. But your financial asset, which is offsetting that, has grown from 39.3 to 57 million over the 5-year period. There's one more graph on the expense side. You can see again over the 5 years, similar to what we looked at the first table, is your expenses in the various categories over the last 5 years in a bar graph format. Then we get into our audit findings. So the status of our audit is we're basically completed the audit of the financial statements of both the Tnrd and the hospital district. We've got some certain remaining procedures up to the date of our audit opinion, and we would have also getting evidence of the board's approval for the statements, completing any subsequent review procedures right up to the date of our report, getting signed management representation letters, and completing any other minor procedures that we have to up to the date of our audit report. A couple of things in terms of, we presented our plan back on the February 3rd meeting of the audit committee. A couple of things to point out in terms of changes from the original plan. Originally, we based our 2021 materiality for the Tnrd based on 2% of 2020 total revenue. So we planned on 700,000. When we got the financial statements for 2021, we reassessed materiality as total revenue had increased over 2020 levels. So we ended up at 1.97% of total revenue, which was $800,000. And same with in the opposite direction, the regional hospital district was planned at 1.92 of 2020 total expenses, which would have been 1.2 million. And as a result of reduction in expenses, we reassessed materiality to 800,000 or 1.9 million, or 1.9% of total 2021 expenses. And that also changes our posting threshold and our performance materiality for both organizations.
They're all the same, exactly. But that is just coincidence. because the cost of logistics is going to decline.
Hear you.
You're correct. And as it declines, materiality will decline accordingly. The second part of our audit findings, just in terms of
Just before we leave that, I'm wondering, asking the other audit committee member, should there be some comment in here related to the forensic audit, just an explanation of the differences between the annual audited statements and the forensic audit. I'm questioning whether or not the public's going to look and say, well, how is this also clean? And this forensic audit came in looking pretty nasty. And I'm just looking, is it worthwhile putting some statement?
I think that's coming up in the next bullet, Al.
Okay, sorry. Yeah, I don't have the documents in front of me. Okay, yeah.
So in the next, just going
Yeah,
through
okay,
other-
good. Sorry.
That's okay. Other significant auditing or accounting or reporting matters. And I think, as we discussed in our audit planning report, we identified some increased risks as a result of the forensic audit. And we modified our audit approach in the current year, and we incorporated additional expense testing and a lot more detailed testing around expenses. It's some additional elements of unpredictability. So maybe areas we hadn't looked at in a prior year to make sure that we've done some audit work in those areas. And these procedures didn't result in any misstatements to your financial statements. I didn't, this doesn't describe the differences perhaps that you were referring to, but I think we've discussed that a forensic audit and a financial statement audit are very different, and we've had some discussions, I think, at our last planning meeting. But this is really, without going into a lot of great detail about the additional work that we did, because I think we talked a lot about it and what our plan was at the audit committee meeting in February. But I think it's more now, here's our findings, a result of carrying out those additional procedures that we didn't find any audit misstatements that would be required to be reported to the audit committee. I think we've talked a little bit already about the landfill remediation liability and the fact that the amount of estimation around that liability that's on your financial statements, and because the costs go out for so long and there's various assumptions being made around discount rates and inflation rates. But also want to just point out that there is that change in accounting standards in 2023.
Al? I have a question
Go ahead.
on that change. Is that going to end up with the board going to have to find some more money from the taxpayer for this? Or I don't quite understand that.
It's not a cash item. What it is a reflection of future costs.
Liability.
At some point in time, it will be cash or something.
It will be. So it's trying to give a better reflection today of what, so the prime example that I always use when clients ask this question is, if you have a building that has asbestos in it, at some point you've got a legal requirement to safely remove that asbestos. So that cost, when that cost will be incurred, you don't know necessarily, because you don't know when you're going to disrupt it. But you do know that there's going to be a future liability. What the new standards is going to say is that you need to record an accounts payable essentially for that future cost of removing that asbestos from the building. And you're going to have on the other side of your statement of financial position an additional amount added to the cost of that asset, so that over the remaining useful life of the tangible capital assets of that building, you're going to amortize additional amounts into your statement of operations as an additional expense. And then you're going to settle that liability with true cash being spent. So it's almost like the charge is going through the same way it does for amortization expense in general, because you need to replace those assets in the future. Well, you need to then remove that asbestos in the future.
I think I understand it. I just don't want a new board 50 years from now to have that really big surprise.
You know, and it will be reevaluated every year, the same way you reevaluate your landfill liability every year. Yeah. So we didn't find any deficiencies or misstatements with regards to your landfill remediation liability calculation. In terms of other matters, I think we talked about, we just move to the next page. We said, you know, that's the biggest estimate in your financial statements. We didn't identify any other significant disclosures in the current year that would be different than prior year. And then on the last, not the last page, but second to last page before the appendix, there was, so if you go to page 10, there was one uncorrected misstatement. So we're required to report to the audit committee both corrected misstatements and uncorrected misstatements. We did not make any corrected misstatements to your financial statements. There was one late invoice received related to the hospital district that was not recorded for a late accrual of $279,000. That would be additional liability and additional expense in the current year above our posting threshold. So we need to describe that to you as audit committee members, but well below materiality in terms of the quantum of that amount.
So help me out with that, Doug. Was that a late invoice that reflected 2020 expenses that got accrued in 2021?
Not quite. So as you recall, when the board passes the bylaw, we're committing to cost sharing on funding on these equipment purchases and construction that IHA undertakes. So we make the commitment. According to the accounting standards, we should be expensing that and reflecting it as a payable liability once IHA spends the money. But they don't tell us right away that they've spent the money. So they've spent money in 2021 that we didn't know about until this month when we got an invoice from them. So normally we try to anticipate that in the financial statement. So we accrued over $600,000 as accounts payable based on IHA giving us an estimate of what they thought it would be that they've spent in 2021 and hadn't billed us for yet. So that's included in the statements. But now that we've actually received invoices, it turns out there's about $279,000 more that they've billed us than what they told us to expect. So it's all part of what we committed to. It's just the timing of when the invoice is for it. And frankly, typically we will make those adjustments up until the point at which the financial statements are approved. But those figures also factor into the budget that goes to the board with the opening surplus and the carry forward. So to make those adjustments now for this late amount would mean the budget no longer reconciles back to the financial statement. So I'd have a choice to either record it and amend the budget or leave the budget as is and leave this as an immaterial unrecorded liability.
So it's go right back in the books or live with a misstatement in the audit finding. So with the supply chain issues that they're experiencing in terms of particularly some of the complex medical equipment we fund, and with inflation today at 6%, aren't we likely to have more of these?
Yes, You'll recall in the financial statements, there's a note that describes what the commitments are. So aside from what we've recorded as an expense in 2021, there's a note disclosure in there that says this is in addition to what we've already expensed and showed as a liability. We have commitments beyond that for stuff that IHA hasn't spent yet. We haven't given them the money yet, but it's stuff that we committed to in those bylaws. So if we were to have recorded this amount in 2021, we would increase the liability, but we'd be reducing the figure in the commitment that we're showing in the notes. So the information is still going out there to the users. The question really is, how quickly is IHA able to translate those commitments into actual expenditures and bill us for our share? And that's been an ongoing issue for them, hasn't it? It's that whole supply chain is likely to get worse. But part of it is just like, we're not involved in the operations of IHA, so we don't get the information until they give it to us, as opposed to our own internal operations where we see the bills and we record them right away. So yeah, it is, and it's historically it's been an issue because it's just that communication gap, and they're doing the best they can to feed that information to us, but it
Yeah,
takes time.
I guess, I mean, and the other thing from a governance perspective, we could just say, you guys want an auto analyzer for merit. Here is our share of $500,000. So it's going to be 400 or 240,000. That's all you got.
And that's basically how it's been working. We've made commitments for, generally a percentage share of a figure that they've given us. They haven't necessarily come back to us and said, it took us longer to buy it. It's more expensive. So now we need more money from you. They've stuck with the amount that we committed.
All right, thanks.
Okay, any other questions? No, I just want to make sure that we're comfortable, around the statements of materiality and the whole forensic audit. If KPMG is happy, I'm happy, but I do think there's going to be the question of why did things that were in a forensic audit turn up that aren't reported in this audit, and that has to deal with materiality. And excuse me, your assignment never asked you to go into the in-depth analysis of expenditures in departments and those kinds of things. We stayed within the realms of materiality here.
Yeah, I think just to comment on that is that in the current year, materiality was $800,000. So we're going to be focused on more material expenditures and revenue items. A forensic audit has no concept of materiality. Everything's material. So, in our financial statement audit this year and in prior years, we're focused on categories of expenses that have much larger balances and much more likely to have a material misstatement in your financial statements. So that's not going to be $1,000 invoice or areas where total expenses are $300,000 or $400,000. That's just not unlikely to produce a material error to your financial statements.
No, I think we understand that. I'm just thinking about this report going to the public. If you're comfortable with it, I'm happy too. I mean, I think we can explain it if somebody asked, but I suspect that people are going to be saying they've heard all these reports around the forensic audit, and yet when you look at these audited statements, it's a clean audit and there's no changes. Do they understand the materiality issue?
Well, Al, I guess the way because I've got the same concerns you have, because I'm going to get asked the questions, right? So it's the tale of two auditors. BDO says the books are a mess and the audit's faulty, and then KPMG says it's an unqualified audit, but there's one's a forensic audit and one is an annual audit. They're two different beasts. And so to the extent that KPMG dug into things a little bit more in depth than they normally would have because of the forensic audit, there is still nothing that they have found that is improper in the TNRD's books. And that has to be reconciled with the public perception that BDO has created with respect to expenditures. And I think that's the piece us politicians have to kind of help them with.
Yeah, I'm just word of reflection too for KPMG. I mean, because what you said, I agree with exactly, except it's clear we don't go to, because of the level of materiality here, we're not in the level of looking at somebody's meal expenses or $1,000 here or $5,000 there. But if KPMG is comfortable, I just don't want it to reflect on you and somewhat on the audit committee, but I'm happy on the audit committee side. I think we can all defend ourselves.
Yeah, I guess, if I can make an analogy, it's like both firms are providing an automobile service, but KPMG has looked at the motor and transmission, and the other audit, the forensic audit, looked at the operation of the struts or something. They're both broadly calculated as automobile service, but one is much more minuscule in terms of a small area, and one is broader about how the damn car runs. And it's going to be a difficult thing to explain, but that's, I think, our challenge as the audit committee.
Yeah, I would use the example more. KPMG is looking at the hiring of the fleet, and the other group were looking at the operation of each vehicle.
Yeah, I understand the challenge, and it's because of the term audit is in both types of engagements, and I think that's where the start of the confusion around what are the responsibilities when it comes to a financial statement auditor, and what's the differences in the forensic audit. It is entirely different, and I think Debbie and I were talking about. We just read a recent report where a very small fraction of frauds are actually uncovered by external audits. It's because in most cases, the dollar amounts are well below materiality is one factor. Secondly, you might have some sort of collusion within an organization, or there might be someone that's able to override controls so that fraud is not uncovered. Where it does come, in most cases where audit or where frauds are identified, it comes from someone within the organization, either your existing internal controls and procedures that finds it, or a whistleblower, or both internal or external to the organization that identifies it, and that's the majority of where those types of matters are uncovered.
Yeah, no, I think we understand that.
Yeah.
It just, I was just a little bit worried that from your side, somebody could be looking and saying, what the hell, BDO says a mess and KPMG says it's all good. How is this even possible?
Well, the one thing that I do want to point out, it's on the next page of the audit findings, that as a result, as I said, we did a lot more in-depth testing around expenses and revenues in the current year. And the one point that we brought forward that is our observation is that you use a roll-up entries within your general ledger. So when we will go and we will statistically use a sample to pick various items within your general ledger within various categories and look for supporting documentation. Well, what happens right now is your accounting department, when they get an invoice, they will often record it to a roll-up clearing account. So it gets paid on a real timely basis. Then once a month, all of these roll-up accounts are cleared out and they're allocated amongst various functions or departments within the organization on a big spreadsheet. So, and that's used where, you know, one invoice might be shared amongst numerous functions within the Tnrd and allocated. So you've got a pretty complicated Excel spreadsheet that is utilized to then allocate those expenses. I think our point would be that, you know, it made it difficult to trace transactions from the general ledger back to the original invoice because of this sort of roll-up methodology that used. And it, you know, you've got some manual component to using the spreadsheet, so that could lead to potential errors. So what we're saying here in our recommendation is to look at this process and see if it can be streamlined somehow, and potentially reduce the use of spreadsheets. Can you code and split the expenditure from the time you get your invoice so that it doesn't have to go through this spreadsheet and then get allocated once a month? You may find that, yeah, that is the most efficient, but what you're dealing with right now is, you know, a fairly onerous process and certainly a difficult process to go from the general ledger and find that actual invoice that relates to that portion of an expense that gets charged to a specific expense account. So it may be that you find some ability to streamline the process, save time. Certainly, you know, your staff, you know, you have a shortage in the finance department. If there's an ability to do something different and streamline the process and use less people hours, then that's going to be a benefit to the organization. So we don't say that, we're not saying that it's necessarily causing an issue, but it's worth looking at whether you can streamline the process.
I thought you may wish to, when you're presenting to the board, go into a little bit more detail, as you did earlier in your statement here, about this observation, just so that it's clear to people the difference.
Okay.
Yep. Just my thought. If you don't want to, up to you. I'm looking more at a criticism. I mean, there's some criticism in the BDO report of the audit committee and the way we have it structured. That's one we can deal with that. I think the question that the board and public are going to have is kind of say, what's the difference between what KPMG does in their audit services for the TNRD and all of these things we heard about in the BDO report?
Sure. Doug, I don't know if you wanted to make any comment on our observation there.
Just that I agree with you, and I have been looking into this sort of methodology we're following of roll-up accounts. They generally get used in one of two ways. One is more or less a summary roll-up. So in solid waste, for instance, we'll have detailed expense accounts for each location. So multiple accounts for the same type of expense, but broken down by site. And then you'll have an account that kind of rolls it up into a summary account. So the detailed information is there in the detailed accounts. It's just more or less a summarizing of all of those accounts into one line. And then the other option, which is more what Brent's been talking about, is where we have a single invoice that comes in. But because we have to deal with the individual services individually, it means allocating those costs to a number of different services. So we will sometimes put them into a clearing account and then sort of look at everything for the month and do the allocations all at once rather than allocating every single invoice as we go, which I understand can create some more difficulty perhaps with the audit trail. So I'm definitely looking into it because I want to make sure it's as clean and as efficient as possible.
Thank you. Any further questions?
Sorry, I thought I was unmuted. We need a recommendation to forward the audit finding report to the board.
Second,
Anyone opposed? Hearing none, motion's carried. Now I think we're on to new business. Yeah, I just had one question I wanted to ask. In the forensic report there, they have suggested a major restructuring of the audit committee. There has been some discussion at the board level of restructuring the audit and whether it's an audit and finance committee. But I guess first question I have is, in the BDO report, they're suggesting the audit committee should be having some separate auditors reporting to the audit committee who would year by year do in-depth audits of various accounts in the TNRD. And I'm still questioning how practical that is. And I guess I'm looking for comments from your side. Obviously, it could be done, but the practicality of all of that. And then I have a second question, which I'd like to direct to Mr. Ray later. Excuse me.
So I think what you're referring to is a recommendation to engage internal auditors. Certainly that can be done one of two ways. Either you hire employees of the TNRD to carry out those functions, or you engage a third-party contractor to provide those services from time to time, whether it be annually or as needed. And they would drill into in more depth certain areas where maybe the audit committee had concerns, or they would basically, the way I've seen it in other organizations is effectively the internal auditors would come with an audit plan similar to how we do for an external audit, where they will determine which areas they're going to look at during the year. Maybe it would be, could be expense reports. It could be, other, certain departments, certain areas where where the audit committee may have some concerns that they want to have a regular rotation in certain areas, or specific projects that they want the internal audit department to carry out. So, it's certainly, I don't know that hiring your own internal auditors is going to be probably the way to go. I think you're more likely to engage a third party to carry out those internal audit procedures as requested by the audit committee. And what you're going to see is you get into a lot more depth than you would than the external auditors like us get into, because you're really focused in on one certain area that you're going to spend significant amount of time, much more so than the external auditor is going to spend on auditing your financial statements, because it's, again, you're not as focused, just like a forensic audit is much more focused into certain areas, the internal audit would be as well. So there can be good value for the organization in terms of recommendations and changes in policies and procedures, or internal controls that come out of those investigations by internal audit.
Yeah, and the second question I have for you is, are you aware of cities or regional districts of similar size that would be doing internal audits? Is this a common practice?
Generally is with larger organizations.
I'm thinking particularly with regional districts and local governments, larger municipalities.
Yeah, larger municipalities would, like, I believe the city of Vancouver engages internal audits. I don't even know if they might have staff. Are you aware, Debbie, for sure? I think Surrey might as well. I thought I remember, I recall an ex-staff member of ours going to work in internal audit at the city of Surrey as well. So larger organizations with, those would have much more significant budgets than the TNRD. But certainly doesn't mean you couldn't from time to time engage a contractor to provide those services in certain areas.
Yep, no, a good advice. Any questions in that, around that from other
Well,
board members?
Al, I guess, I've worked in, with the school district, I worked with the city, I've worked with the university, I've worked with the IHA. The only place that had an internal auditor was IHA, but they're a $2.7 billion organization. And bless her heart, Giovanna De Bruin, I'll never forget her name. She was kind of a efficiency, kind of quality control kind of person that looked at processes and gave recommendations to operating divisions, how they could actually streamline and save money in terms of the way that they functioned. And we used to fight back and forth about whether or not we gave mileage claims or we bought vehicles and sent people to work that way. Around here, it would be like the building inspectors. Do we send the building inspectors to work in their own truck and give them 61 cents a kilometer, or do we buy a truck for the building inspector and amortize the cost of that and pay for the tires and all of that sort of stuff? And one year it works this way and the other year it works that way. It's not a particularly exact science. But the other thing I did want to mention, though, is the recommendation that we have a CPA on our audit committee. We've got this little happy gang of three of us here, none of whom is a CPA. But I'm wondering, Brent, from your experiences, do other organizations seek out and appoint a CPA, or is it more lay people that are going to be doing that function as the audit committee?
Well, generally on most boards, they would have a CPA as, on the audit committee. Just for that very fact is they understand, they can read financial statements, they understand auditing, they understand accounting policies. So I think from that perspective, I guess it's whether or not you can, right now you're an elected board that also, generally speaking, the audit committee is made up of elected directors. But there's nothing to say, I don't think that you couldn't add, am I correct? And you could add a non-director to the audit committee, or is that required under your existing bylaws?
I guess where does it stop? You could add a lawyer, because we seem to be dealing as elected people in legal matters. We're, all these other kinds of professionals you could put in there. I do see, though, some potential areas of conflict. So if you get into a situation like the BDO report talked about, and they said the audit committee is at fault, and Director X is a CPA on the audit committee, are you not using their professional designation beyond the extent that it's going to be applied in terms of their oversight as a member of the audit committee? So I think you run a bit of a tightrope there as well.
Yeah, perhaps.
Points.
Al?
Yep.
Just to further to what Kenneth said, the election happens every 4 years, and you never know to sit around this table. And so the chair of the day has to look at people's skills or whatever for any committee. And there may or may not be a CPA. So you have to go with what people put in here. And it's up to us to try and learn as much as we can.
Yeah.
And for me, it's been a nonstop learning curve. But
Yeah.
that's the only one on the BDO I had it made me uncomfortable.
Yeah, I do think the advice we've had from KPMG is probably good, and it's from time to time, you would engage internal auditors to look at various departments, and time to time being on some regular basis, but by contract. And you could and do an in-depth internal audit on certain functions. I think that makes good sense. The second point I wanted to ask is I saw recently that finance is shipping detailed statements on and I think it's going to be on a quarterly basis to all directors. And I'm just wondering how that impacts the audit committee, because if the directors are receiving the detailed expenditure accounts for all of the Tnrd stuff, does that require this audit committee to be restructured so that it is also receiving those same statements and going through an analysis of that statement? Or do those directors who receive then the detailed statements kind of become some kind of quasi unofficial audit committee? I was a bit confused by that.
Sorry, that question's addressed to me?
Yeah.
Yeah, so, I've begun providing a detailed checklisting for each month to the entire board, with the idea of adding greater transparency and enhancing your ability to ask questions, as you see fit. Personally, I am in favor, and I know that Ms. Campbell is in the process of looking at all of the committees and what their structure is, and certainly the audit committee is one of those. We're taking into consideration the expansion of the mandate from a pure audit committee to more of a finance committee. I like the suggestion of having an expanded finance committee that would have that more detailed look at the finances, receive reports, be able to have more in-depth discussion and do more in-depth analysis. That can come with additional training. Doesn't necessarily have to be a CPA on the committee, but additional advice and training can come. And that may supplant the reports going out to all the directors. The idea with sending out those reports was, at the very least, enhance the reporting and information you're receiving more immediately while that other decision is being worked on. And I guess that, you might have a point of saying you're kind of creating a two-strata system of a finance committee, and then all the other directors receiving detailed information as well. But maybe that's not a bad thing.
I would just say that administratively, that makes no sense to me whatsoever.
Yeah.
You might as well disband the audit committee and have the board be the audit committee.
Chair Rain,
Yeah,
it's Scott here. I think the whole purpose of that, though, that was brought up by a board member at a board meeting, and the whole purpose was just public transparency. And so if that changes with a new committee, or if that changes going forward, I think that's fine. But I think that'll come in time as we kind of roll out these new ideas around committees. But that was, I think it was Director Rothenberger that brought that up, wanting to see those, and the board agreed that that would make sense. And that's why we're just simply bringing that up for public transparency.
yeah, but I hope you understand my point.
I certainly do. Yeah, I do.
The audit committee meets twice a year. When we even once asked for a meeting, we never got the meeting. Twice or three times a year. And all of a sudden we're now saying, hey, we're going to provide monthly reports, or even quarterly reports going to all directors. Either the audit committee takes a role in there, and you have monthly audit committee reports that go through that before that goes to the directors, or you basically say there's no need for an audit committee because all of the directors are going to be involved.
I think you're right. I think we can understand what that process looks like, and with the new committee suggestions, I think we can streamline that to basically answer what you're requesting or what you're mentioning.
Sorry, unmute myself. Yeah, are there any other questions from
Yep.
audit
One other?
committee members around that?
One other, please, Al.
Go ahead.
We've been putting those out for what, 3 or 4 months now?
Yep.
How many discussions or information requests have you had from the public?
None.
Thank you.
Well, it's not. Sorry, I wasn't so worried about the public, and I think having the information, even people's expenditures, reported publicly like they would at federal government level, is a hell of a good idea. But the question I'm just saying is, I'm trying to figure out this in this restructuring of the audit committee and possibly audit finance committee. We should be looking at that, because I think we've usurped the audit committee a little bit by saying, hey, all the directors going to get monthly statements that aren't reviewed by the audit committee prior to going to directors. Any other questions on those issues? No, and I did, one thing that I would like to suggest on the agendas, I didn't have any input to this agenda, but we have in the past had in-camera sessions where it's the auditors and the audit committee one-on-one, and I believe that's an important part of doing a due diligence here. I don't think we need it today, but I think in the future we should certainly have that ability in each meeting. Comments?
No, I think that's a pretty good idea, Al, and I think most of the organizations would do that. This have one-on-one time with the auditor. I don't feel the need today, but the other thing that I'm just a little concerned about is this notion of audit and finance committees. And we have a pure audit committee here, which is focused on the audit. If you start making it an audit and finance committee, the audit part is kind of rationalizing all the finance stuff you've done. So there seems to me to be some advantage to keeping them distinct. I was interested in the comments on best practices in that regard.
Yeah, no, I agree 100%. By just raising the issue because there's this restructuring and rethinking going on, but we as an audit committee haven't had any discussion on most of that. So I agree 100% with you that these are two distinct, different committees.
Just Al, just a question on going into camera. It's more for Ms. Campbell. Before any committee or board goes into in camera, does it not have to clearly state a reason?
Yeah, no, and the reason would be because of in looking at internal personnel confidential issues.
Chair Rain, can I comment on that and just the comments on the audit and finance committee on the in-camera portion? Absolutely. If the chair or someone gives myself and our recording secretary who prepares the agenda a heads up that you'd like an in-camera portion and what the reason to close would be, then of course we'll include it on the agenda. We just need a bit of a heads up. And then with respect to the audit and finance committee discussion, I believe Mr. Ray mentioned this, but staff are currently working on a very extensive and fulsome review of all of our existing standing committees, including looking at best practices and what other local governments, in particular regional districts, have in place with respect to audit and/or finance or both. So you can expect a report and a presentation from me on that at a May committee of the whole meeting.
Yeah. Good, thank you. I just wanted to make sure that there was some discussion at this audit committee meeting about those issues so that we understand what's going on, because we've had no discussion on those issues.
And thanks, Chair Rain. This is actually helpful because we're in the middle of doing some research on the committee. So it's helpful to get some of this feedback from the audit committee that can inform the presentation in May.
Yeah, good. Are there any other items for new business? Hearing none, then we'll move on to adjournment. Motion to adjourn. Do I hear a motion to adjourn? Oh, not hearing anything anymore.
They weren't using their mics, Chair Rain.
Oh, okay, so the meeting is adjourned.